The new regulatory wisdom is a collection of new regulations, laws passed by national regulators and implemented at the international level, actually, in order to tackle financial and banking stability. And these measures were made and implemented in the aftermath of the global financial crisis in 2007 and 2008. They were approved at the international level and then again established and implemented by national regulators from 2010 onwards. The major piece of regulation that central banks and national regulators have implemented is called the Basel III Accord, approved again at the international level. So the Basel III Accord mainly establishes a tighter bank capital ratios. Actually, it doubled on average the ratio, and established also a new much higher liquidity ratio, meaning that banks' assets needed to be from that moment on much more liquid than before. So the intention of the regulators was to make banks safer. They were blamed by regulators for the collapse of financial markets in 2007 and 2008, and they needed to be safer. It is in this scenario in which we need to analyze and understand all these changes. So Basel III is at the core of the new regulatory wisdom for sure. But it has also affected other financial institutions such as pension funds, insurance companies. They now need to be much more risk averse. There is also the concern by major international regulators and also national regulators to make banks smaller. The so-called universal banks were, in their eyes, at the core of all the troubles in 2007 and 2008. By universal banks, I mean banks would do both retailing activities, so commercial banks activities, traditional payments and deposits activities, lending to the private sector, for example, and also investment bank activities, so trading in markets. So what the regulators have tried to do in different jurisdictions, certainly in the US, different countries in the Eurozone and in the UK, is to try to split up these two divisions or branches in the banks, so that in case the investment branch collapses, it doesn't affect the retailing part of the business. It doesn't affect depositors, households, businesses, and so on. So this is majorly what the new regulatory wisdom has consisted of. Well, there have been many at the micro level and at the macro level. So the intended effect by the regulators was again to try to make banks safer. We need to prevent a major collapse in the banking sector, the financial system, and we need to be tougher on banks. That was an obsession in the aftermath of the global financial crisis. So one of the intended consequences of this regulation has been to make it tougher for banks to expand their businesses. Actually, I do believe that what regulators wanted to do is to shrink the business of banks, in particular their investment branches. So what they did is to increase capital ratios. So it was more difficult for them and more expensive for them to extend the loans to their clients to create more deposits. And this has produced, in most cases, the shrinking of the balance sheets of commercial banks. It's true that some claim that this shouldn't be so bad for the economy, because the lending that is not going to be provided by banks, it can be provided by the capital markets. So it can be a big corporation, a multinational, doing business with capital markets, asking for borrowing in capital markets rather than going to a bank. Well, this is true for big players in capital markets, for big corporations, but it's not that true for households and for small and medium enterprises. So we still have to pay attention to the consequences on lending of tougher banks' capital regulation and higher liquidity ratios. So again, all the intention of the regulators was to make it more difficult and more expensive for banks to extend their businesses, to expand their balance sheets. And this has produced, to some extent, an increase in the cost of lending. It has made it more difficult for borrowers to borrow money, and has produced, indeed, consequences on the economy. The most important macroeconomic consequence has been that in the midst of one of the most severe global financial crises in 2007 and 2008, the only one compared to the Great Depression in the 30s, international regulators agreed on tightening the rules applied to banks. Again, in the midst of a global contraction, it was not the best timing, and actually the implementation of the Basel III Accord from 2010 onwards has produced an even tighter and much more contractionary monetary environment in major economies, and this has impacted very severely economic growth in these economies. So this is what this paper that has been written by Sir Adam Ridley and published by the Institute of International Monetary Research focuses on the consequences, the intended but also the unintended macroeconomic consequences of this much more tougher regulation of the economy. That, in my opinion, it has aggravated the crisis, the 2007 and 2008 crisis. One of the lessons is that, yes, indeed, we should focus on and we should analyze the effects, the microeconomic effects of regulation on banks and financial corporations in general, but we should also pay attention to the macroeconomic effects of these measures, which I do really think that were mainly disregarded by regulators at the time. And for this analysis, we need to understand properly how money is created in our economies. It is not just created by central banks and regulators. That's only a tiny little proportion of the money we use in our days. But it's mainly created by financial intermediaries, and in particular banks. So whenever we change regulation affecting banks' businesses, or banks' business in particular, we do really need to pay attention to the macroeconomic effects on the amount of money they will be able to produce, to provide to the economy. This is vital in order to assess how sound or stable the new regulation has been. Another lesson is that, yes, it may be fine or fair enough to change regulation if we think that we should tackle a problem in an industry, for example, but what we can't or shouldn't do is to continuously change regulation. This produces instability and uncertainty in the market, and this is exactly what has been happening in the banking business in the last few years. It has made it very difficult, very costly for banks to comply with regulation, and it's becoming less and less profitable for investors to invest in the banking sector. So that's something that we also need to take into account. So basically, for the future, we should analyze the intended, the unintended macroeconomic effects of bank regulation, and we should provide the more stable regulatory scenario as possible in order for banks to do their businesses.